go ahead and switch gears and talk about the second one in case we don't want to get rid of Fluor. And this challenge stock number 2 in this case is Wolverine Worldwide. This one's near and dear to us here in Michigan. It's a company out of Rockford, Michigan, which is near Grand Rapids, Michigan. And they're probably most famous for their hush puppies. You can't get any less flashy than hush puppies. That's cute, but pretty steady and just not. It's just not a Chinese internet company or even a Chinese pulled pork company, right, Ken? One of the things that you can notice from this, though, is notice that the long-term trend line for Wolverine Worldwide, again, maker of hush puppies, most of these annual sales results actually touch that long-term trend line, so they do not drift around, even though there is going to be some economic sensitivity. Obviously, people are somewhat sensitive to economic cycles when they decide to buy shoes, and they do make more than hush puppies. They make some pretty cool stuff, and the Wolverine brand itself, and they actually brand some products for Caterpillar, which is probably near and dear to the ladies' hearts there in Central Illinois, and Harley Davidson and a few others. They also make the Merrell brand of footwear. But this is a real steady picture over the last 15 years, including a couple years of forecast. You can see that we've got some forecast in here on the right-hand side. So again, the long-term picture is about 6%. One of the things that I like to point out is that companies like Wolverine, we're going to cover this in greater detail here in a few minutes, Wolverine to me is an example of one of the companies that really stabilized our 10-cup model portfolio back in the time frame from 2000, back during that horrible bear market back in the years 2000 to 2002. And what I've captured here for you is the performance of Wolverine stock, back at the turn of the century versus the red-hot NASDAQ. I'm using the quadruple Qs as the NASDAQ. You can see that quite a plummet there on the NASDAQ during a period where all stock markets, including the NASDAQ, took that horrible plummet. Notice which direction the hush puppy company went. And a lot of times we're asked, well, how did Tin Cup do as well as it did back in this time frame? There are a couple other companies like AutoZone that actually did this. So the role of companies like Wolverine, again, it's not flashy. It hasn't been flashy for years. But it's very stable, very steady, and it really, Wolverine Worldwide made a tremendous difference in our 10-cup model portfolio that we talk about in our newsletter every month. And you can see it right here. That's just such a powerful bolstering of the portfolio. So that's what I think of when I think of Wolverine, aside from the fact that they've been very supportive of our community of investors for years. They have actually hosted events at their facility out near Grand Rapids for investment clubs and the local investing community. Staunch company, staunch company. This is what the ladies see, the Beardstown perspective on Wolverine Worldwide. Their cost basis in Wolverine Worldwide is about $250. Back here somewhere. I suspect that they actually bought Wolverine back in the early 1990s. And I don't know, that's a 14 or 15 bagger if you want to put it in Peter Lynch terms. But I'm sure that the ladies see Wolverine Worldwide as, it's had its ups and downs, but that is extremely powerful performance over the long term. And it's more like a good old friend slumbering on the front porch there in the sunshine. The annualized return on their investment in Wolverine Worldwide is 16, and I don't think we have to call Price Waterhouse to check that. You can check it right there. And this is probably their vision of Wolverine Worldwide. And it's real easy to get emotional about this kind of stuff. And one of the things that we counsel is you've got to try to find a way to set the emotion aside when necessary, and don't ignore the tax effect of that low cost basis, but don't let the taxes get in the way of making a selling decision when the time is right to do so. So let's take a little bit closer look at Wolverine Worldwide over the last few years. This is actually a phenomenal story of increasing profitability. They're really doing a nice job of managing the product portfolio. They've gone from net margins in the 6% range up to where the forecasts are actually more in the 8 to 9% range on the right-hand side of this chart. So again, going from levels of 6% to 8%, that's quality management. That is excellent management during some fairly challenging times, we might add. We do see a little bit of volatility in the PE ratio over time. You can see that it has bumped up and bumped down. Pay attention to the scale. I mean, those are not big moves one way or the other, and seems to kind of love to sleep on the porch around 14. 14-ish is a decent PE for the company. Here's a little bit different look at that same situation, the same type of chart using our chronicle for Wolverine Worldwide, and what you can see here is, again, a bit of a buying opportunity perhaps right here, perhaps a selling opportunity back in this time frame. Again, perhaps. I mean, if you had sold at 20, you might have had an opportunity to get out at, or if you had bought it at these levels, you would have had an opportunity to get out. But again, a real nice buying opportunity here, and it has actually come up very nicely in recent months. Here's a look at that same guide, equity analysis guide for Wolverine. Again, we're talking about a much smaller company, but it does, in terms of sales, but if we can assume a 6% growth rate for the company, and that seemed pretty reasonable based on the visual analysis, and 9% margins, you could even make that 8%, PE ratio in the 14 range. Those are the three milestone assumptions. We're talking about a high-quality company with a projected return of 4 to 5%. So again, nothing that you would run and rush to sell, but for demonstration purposes here tonight, we will talk about selling half the position and just redeploying the cash just for demonstration purposes. And again, keep in mind that I'm treating the portfolio as if the ladies have adopted me and given the portfolio to me to take care of as my own. Ken, did you have a question or a comment?
Yeah, I wanna make a point that my wife made to me about 4 or 5 months ago about Wolverine Worldwide. She maintains that they have demographics on their side. I'm in the first year of the baby boom, just turned 64 years old, and I bought my first pair of hush puppies about 5 months ago, and I've been wearing them ever since. I really like them an awful lot. And Natalie is indicating that with the baby boom aging, Wolverine just might be onto something for old men. So I'm just letting you hear all about that, okay?
Yeah, they have a pretty robust portfolio, and you're right. They're pretty well positioned demographically, and it's a fascinating study.
Mark, we have a question from Kay. I'm going to unmute her. Kay, go ahead. Kay, you might be muted at your end. Evidently, Kay is having some sound problems, Mark, so we're going to mute her again and take her hand down.
Yeah, go ahead, Kay, and enter your question in the question box, and we'll certainly attempt to address it. Let's go ahead and remind everybody what the portfolio looked like. Again, Wolverine Worldwide is among the potential challenge stocks at the bottom, and it is among the largest holdings. So again, you don't have to rush into this, but if it were my portfolio, I would be patiently awaiting that opportunity to perhaps unload a few of those shares and reposition the portfolio. So I'm going to spend the last few minutes here talking about this concept of letting the portfolio be the shopping guide. And as you saw earlier, we sorted from top to bottom, so the better shopping opportunities are at the top of this chart. And then we also noticed that companies like Teva, that's the generic pharmaceutical company out of Israel, very strong company, has a fairly small position in the portfolio at less than 2%. And you can also see this intriguing Our Pets company at less than 0.5%, and then the third one here, Staples, at 3% of the portfolio. All we're saying is that there's room to add. These are not what you might deem as a full position. What I mean by that is, even though, let's say in this situation, Pepsi or Medtronic actually look reasonably attractive, they're not attractive in this case because they're already at 9 and 11% of the portfolio. So no matter how attractive they look, you would look towards other candidates when shopping in the portfolio. So in the interest of time, what I'm going to do is just basically sell half of that Wolverine Worldwide position, 600 shares, and then basically distribute the approximate $22,000 almost equally 3 ways by buying 150 shares of Teva, 1,500 shares of our pets, which is kind of a fascinating story, and we'll see if we can't talk about that in a little bit more detail, and 300 shares of Staples. And again, think about what we're doing. We're taking a few percentage points of discretionary, putting a little bit back in discretionary, so we're not going to be messing up the pie chart, switching a little bit of it to healthcare, and a little bit of it to consumer staples. So all of those things are okay for the portfolio. And this is the way we coach your council investment clubs to think about this process. You know, think about your portfolio in the before condition, and then think about, well, what would those 3 transactions do? And in the case of the ladies' portfolio, we would add nearly 1% to their projected annual return, taking it closer to 11. That's not completely where we want to be yet, but that's a step in the right direction. You know, we're aiming for 12 or so. You don't have to do this overnight. You do it over time. You just march towards it. The changes we proposed would not disturb quality at all, and they would tack on just a smidgen of sales growth. And you probably want to achieve over the longer term even a little bit more. You know, find some high potential candidates. Again, think about the before and after picture. So again, here's kind of the situation where, again, we've dropped Wolverine down in the portfolio down to 8% of the total portfolio. It's still a significant contributor. We'd be watching it closely. Watch the next update. You can see that our pets is now up to about 1% of the portfolio, and we do have a little bit of cash left over. That it's okay to hold cash. One of the great myths out there is that stuff that's in cash is not invested. That's completely wrong. It's one of the myths that we've really trashed over the years. If it's invested in the investment club, even if it's in the cash account, it's invested. Mr. Nicholson would have been rolling in his grave to hear us think that we have to always, at all times, have that cash invested. And there are just times when it makes sense to leave that in cash, in fact, perhaps even accumulate a little bit more and carefully shop for opportunities. So we want a little bit more par and a little bit more sales growth going forward in future monthly meetings of the clubs. I want to take just a moment to drive this home even more, I think spectacularly. I mean, some investment clubs have really got this down. Others are struggling with this concept. Let's talk about this. I mean, since the year 2000, this is basically an 11-year look at the S&P 500. And notice that the S&P 500 was here back in 1999, and it's here now. So if you happen to be in an investment club that is heavily overdosed on the S&P 500, you know, high-quality blue-chip, large companies, chances are you don't exist anymore. You probably gave up somewhere along the line here. Maybe this second dip down is what nailed many investment clubs. And the point that we want to make here is you don't have to, and you don't want to invest completely in large companies. The value line arithmetic average is a blend. It's the 1,700 companies in the value line standard coverage, but it includes small, medium, and large. So think of the value line arithmetic average as all of the above, including small, medium, and large size companies. And notice the performance of this over the years. This is so important. If you need a 2x4, here's a 2x4 for members of your club. If you can convince your club to invest in medium and small sized companies. During 2009 alone, by investing in small and medium companies along the way, it went up 69% in 1 year. You know, during a year that wasn't that good in general for the total stock market. It was okay, but 69% in 1 year. Just notice over the long term that small and medium companies have made a significant contribution. It's one of the reasons that Ken Kabula talks about them so much. So again, just something to think about. Have small, medium, and large companies in there. Our translation of that is make sure that the sales growth forecast, your average sales growth forecast for your overall portfolio is somewhere in that range suggested by Nicholson of 10 to 12%. You'll just naturally get on that blue line. just to demonstrate some current opportunities that the ladies might want to consider. I actually went and did a quick screen looking for smaller companies. Again, that we translate that to slightly more rapidly growing companies, the companies growing at 12% or more, and limited the field to that. I wanted financial strength of at least B+, and normally I'd be a little bit more stringent, but I left it at B+ for now, or 50. We want straight lines on our guides, so we went with 60 for the stability. And I want, strong projected returns, greater than 12.5%. I don't want to get too carried away. And excellent quality companies. You want to stick to the excellent quality companies as best as you can at all times. And there, a couple companies kind of spring out. Zhangpin is a Chinese pork producer company that has come up in a number of our discussions, including Ken has nominated it twice for the roundtable session that we hold that manifest on a monthly basis. So I thought the ladies might have some interest in that down in the hog country that they at least live next door to. Good company to study, high growth rates, intriguingly low PE ratios. It is a Chinese company. You want to be careful with that. Dolby Labs has been showing up on a number of groundhog entries for 2011. That's our stock picking contest for the next year from Groundhog Day to Groundhog Day. And I see why here. With very high quality ratings, everybody knows that Dolby makes those high quality speakers. Some pretty good stuff there. BioReference Labs also showing up quite a bit in the groundhog community, and Cy Lynch has featured that a couple of times for the roundtable. So the best description I've heard of them is they're kind of a New York version of CSI, commercial industrial version of CSI with a very intriguing looking picture. There's a few other companies on the list that you might want to take a look at, but that's just to give you some opportunities. Again, if I was going shopping with the residual cash from the transactions we just talked about, I'd be really focusing in my studies on the ones here at the top of the list and thinking about going for some of these. There's some good ones on the lower half of this too, but some of those at the top are particularly compelling. You want to find the one that fits the portfolio the best. So with that, I'm going to go ahead and wrap up again just by talking about we thank you for sharing your portfolio with us, Beardstown Ladies. Keep doing what you're doing. One of the things that I was most enchanted by was the fact that the club is continuing, and perhaps we can get a comment from the ladies about the multiple generations, daughters and granddaughters that are involved, and that the club continues to explore new areas like your conservative option strategies and just bringing new members into the club to carry on the legacy and the traditions that you've established. I just thought I'd kind of quit by sharing a story that Betty wrote about when I believe it's when they were in New York around Christmas time for the Donahue show. All the restaurants were closed and they couldn't find anything to eat, and when they walked into their room they found that they'd been taken care of. And I'm sure I echo the words of many people in the long-term investing and the investment club community by saying we also thank you, Beardstown Ladies, for inspiring us and certainly taking care of us along the way also. So on our website we will be posting the audio version of this slide presentation, and one of the things I would like to invite now is any comments from the audience, anybody that wants to share any thoughts for the Beardstown Ladies, but you can also do that in our forum or on the Facebook page. Share your Beardstown Ladies story. I'm sure the ladies would love to hear from you, and I would appreciate anybody that wants to go ahead and do that.